Okay, so this is Lending 101, and Becca and I are here with Zach Stiles, who's one of our local lenders and preferred partners. Zach, thank you for sitting down with us and doing this today.
I'm so excited to be here. Thank y'all for
Yeah.
having me. Love Remax and love talking about lending.
Awesome. Well, let's go ahead and get started. This first slide is talking about the mortgage process, and I know we're going to dive deeper, but if you can tell us a little bit about yourself and a little bit about the overview of the mortgage process.
Yeah, absolutely. So, Zach Stiles with the Roy West team of Guild Mortgage. I've been in the business for the last going on 10 years now. And my father-in-law started the business over 20 years ago. And we have been right here in Beaumont servicing all of Southeast Texas and Louisiana. And we love talking about loans. And I really enjoy working with first-time home buyers and new agents, just kind of explaining the process and making sure that everybody understands where lending fits into the whole home buying process. And
Absolutely.
and kind of just, I guess, to answer your second part of that question, talking about the mortgage process, it's very important to start with a lender. So we get excited about purchasing a home, and talking to a real estate agent is wonderful. They are likely going to connect you with a local lender, and then that's really where you need to start before you really start looking at homes, because getting pre-approved, and we're going to talk much more about this, but it really gives you the confidence to know what you can buy, where you can buy, how you can buy, where funds come from, and really take all of the guesswork out of the process. So, the process is we get you pre-approved. There's some steps that we'll go through regarding that process. And then you'll find a home, you'll work with your real estate agent. They will negotiate on your behalf to get you, under contract. And then I always tell people, after you go under contract is where we really start the lending process per se.
Absolutely.
Because at that point, we're going to get any updated documents that we need. We will actually send out initial disclosures, which are going to be DocuSign per the loan program, that we've already sent you numbers on and kind of discussed. So there really won't be any new information outside of, you'll just sign the actual government documentation that is required by all lenders to be signed. That's all going to be DocuSign. And then we work through some of the early lending process, which is ordering the title work, ordering the appraisal. If it's an FHA, we'll get FHA case number, things of that nature. But that's kind of the initial process. And then after you get credit approval, there's always a couple of additional documents that an underwriter is going to need or want to see. Once you get those documents, or your buyer gets those documents back to us, that's when we issue the clear to close and order docs for closing. So it takes about 30 days for the entire process. And we do our best to work with all parties. I always say that the lender is the mass communicator, alongside with your real estate agent. You're likely going to get the most communication from your real estate agent and the lender.
Absolutely. No,
Awesome.
I agree. And that is why it is so important to choose a good local lender as well, which I know we'll talk about some of that as we go uh, throughout this class. But why is it so important to get pre-approved before looking at homes? I know it says here that it can help you understanding the strategic and financial advantages of securing lender pre-approval prior to beginning your property search can give you an advantage with making your offer. But I know you were mentioning yesterday when we talked to as well about just how it can make them feel more comfortable along the way. You can share a little bit about that if you'd like as well.
Yeah, absolutely. So I always tell folks that you want to get pre-approved for lots of different reasons. First and foremost, the lending world that I live in is highly, highly regulated, right? And it's federal guidelines that are nationwide, and we have to make sure that we check a couple of things. And what we really want to do is we want to put your client in the best possible position to purchase a home.
Mhm.
So getting pre-approved first can tell your client a lot of things about where they currently stand. Some folks are ready to go right out of the gate, right? Their credit score is where it needs to be, debt to income's where it needs to be, the job history is where it needs to be. Some of those things, they have the money also. Some of those things are things that, they may seem like no brainers, but when you're working with first time home buyers and it's the first time for these folks to ever even think about doing this, these aren't on the top of their mind, right?
Mhm.
So I try to tell my clients and my employees every day that, like, while we do this every day, this is the first time that a lot of these folks have even thought about any of these
Yeah.
things. So we really try to break it down, because a lot of times your buyer is not necessarily going to know what they don't know. So getting pre-approved first, not only does it help you as their agent understand where to put them as far as a house price point and things of that nature, but you're also talking to a buyer now that understands, okay, I know what this monthly note looks like. I'm
Mhm.
okay at a $200,000, dollar purchase price. Whereas before they get pre-approved, they may think they're okay with the $200,000 purchase price,
Yeah.
but maybe that isn't what they really want to pay per month, right?
Mhm.
So really knowing your budget, where the client's comfortable, because a lot of times we can get people qualified for a house that's a whole lot more expensive than what they actually want to pay.
Yeah.
And nobody wants to be house poor, right?
Mhm.
So that's one real important aspect of being pre-approved first. And then also, your offer is going to be more strong or stronger offer because you do know your numbers. You do know what you have and what you are going to need for closing. And a lot of times we'll actually even send a file all the way through underwriting and have it credit approved. And we can actually notate that on the pre-approval letter and close faster than what I talked about earlier in that 30-day period if we already have that client's information. They're
Yeah.
already credit approved through underwriting. And that's kind of where it leads into the second part of accelerating the closing. And then lastly, nobody likes surprises in the home buying business. We all love surprises on our birthday and things of that nature and anniversaries. We don't like surprises when we're buying houses. We don't
No.
want the, oh, by the way, you need to pay off XYZ. We want all that to be on the front end. If they need to pay down debt, if they have things they need to work on regarding their credit, right? If they
Mhm.
need a little bit more time at a job because we're having to average their income over a certain period of time, those are all things that we can uncover in that pre-approval process. That if you've already gone to a house, fallen in love with it, your real estate agent has already, made an offer for you, but then now you're just now getting pre-approved, all of a sudden it becomes a whole lot less fun if I have to be, or a local lender, I should say, has to be the bad guy and be like, I appreciate the fact that you love this house, but we
Mhm.
need to take X, Y, and Z. It's not nearly as much fun if we have to go down that road.
Yeah, no, absolutely. We always talk a lot about to the agents about managing expectations with their clients and getting in front of issues. And I think that this, what you were just saying, makes a whole lot of sense. That's the first opportunity in your transaction or in your relationship with them to get to do that. So yeah, no, I think that's
And
great.
I think it's important also, like I know, and Stacey will agree that when we are have a real estate hat on, and whether I'm on the listing side or a buyer side, it's a lot easier to have a local lender that has a good reputation behind
Mhm.
them that says, oh, who are they approved by? Zach Styles, like that. They're like, okay, I'm good. Sometimes they're
Yeah, you can trust it.
like, yeah, definitely. I don't advocate for this, but they're like, if I say your name, they don't even ask for the actual pre-approval. They just know if Zach's got it, then okay. If
Yeah.
you say so, I'm good. You know?
Yeah.
So I mean, and that makes also when you're in a transaction with the other side, it makes it a lot easier, whether I'm the listing side and have the seller, or if I'm making an offer on a buyer and they are approved with someone who's got a great reputation, it just makes the process a lot easier.
I also
That's right.
like, he mentioned about if there's any credit issues that come up that they identify, being able to kind of help them, knock
Mhm.
those out or know about the timeline they could to get ready to buy. And I think that's really good because we talk about that in a lot of our lead generation classes of staying curious. And like if they say they're not ready for 9 to 12 months, kind of tell me why that's important to you. And if they think that credit may be an issue, connecting them with a local lender up front that can help them do that properly, I think is also super valuable and something that we can add as a value add as an agent.
Yeah. And I will say one other thing that a lot of times, in the lending world, the guidelines in the loan programs are changing on a pretty regular basis. But there's
Hmm.
oftentimes that we have maybe a loan program that ordinarily somebody might not think of, maybe for a self-employed borrower.
Hmm.
And sometimes buyers in their mind will just think that they can't buy a home because of X, Y, and Z.
Yeah.
What I would encourage any new agent to just do is just get them connected with a lender,
Hmm.
because we have loan programs that are coming available all the time, and things are always changing. So don't necessarily pre-approve, your client before getting them in touch with a lender. Let
Absolutely.
the lender kind of go through some of those exercises with the
Hmm.
client.
Yeah, and I love
Love
like
that.
pre-approve or sometimes in our case pre-deny.
Hmm.
We hear
Mm-hmm.
something and we're like, "Oh yeah, you're not ready." Like I know it's I'm like, "No, like I don't know
Yeah.
every loan product out there, like
Mm-hmm.
send you to a lender. I might think that I know,
Yeah.
or in my experience, it's probably not looking good, but the end all be all is with the lender, what they say if you are good or if you're not. And there have been times that you're like, wow, I didn't know that they had that product and we're good to go.
Yeah. But it keeps
Yep.
them in the loop and it's a great follow-up until they
Yeah.
do get to the point that they're ready. I love that.
Yep.
Thank you. Okay, so if you want to share a little bit more about the levels of pre-approval and how that differs, I know we've heard differences between pre-qual and pre-approval, but you were talking a little bit about that yesterday as well.
Yeah. So this is kind of one of those topics that it depends a lot of times on the lender and
Hmm.
what that lender does as far as their process goes, right? So the way that we operate may be a little bit different than, say, an online lender or things of that nature. Okay. So what we typically are always doing if we get a new client is we're always going for pre-approval. Okay.
Love
So
that.
we're actually getting the documents, we're going through all of the different options as far as what makes the most sense for the specific client based on their, documentation that they send over, assets, pay stubs, work history, things of that nature. So we automatically on the front end will grab as much information as we possibly can. And typically 99% of the time, we're going to be sending out what's called a pre-approval. So that means my processors looked at it, I've looked at it, we've done a full doc review. We've looked at all of the things that could potentially be surprises, before they become surprises, right? So that's kind of the pre-approval. The pre-qualification is more of a, hey, we pulled credit, we haven't looked at documents, we have a good idea of what they look like. They're going to be sort of kind of ready to buy a house. We can pre-qualify somebody just based on some information that they give us, but that doesn't mean that we've received all the documentation and
Hmm.
received all those types of things. So really the pre-qualification is kind of the first little initial step. A lot of times I compare that to, hey, we have a loan application from those people,
Yeah.
right? And their credit looks good and what they've told us looks good. We really like to go ahead and get the documentation, because what I've seen is our pull through is a whole lot higher if the client has some skin in the game. So one of the questions that as a buyer's agent you may ask is, hey, have you gotten the documents that the lender's requested to the lender? Right? Because that'll give the buyer's agent an idea of how much, information the lender's actually had a chance to review and to look at.
Hmm.
We live in an area that has a lot of what's called variable income, which is
Yeah.
hourly income. And it's not uncommon for me to have a client that's had 12, 13, 14 jobs in a 2 year period. And
Hmm.
we literally have to average that income over a 2 year period. So the pre-approval process, we're getting all the verifications of employment from that for that client from all those different employers. We're really going that next level to make sure that our income is strong and solid and all those types of things. Whereas a pre-qualification, you may just have the information, but you may not have actually calculated income. So I personally really try not to send out a pre-qualification letter. I would much rather send out a pre-approval letter, because that means that we physically received the documents and the things that we have from that
Absolutely.
client.
Well,
I feel
and,
like
Um,
a
and doing,
pre-qualification is almost like going off of what the buyer claims
yeah,
that the income that they have, and then pre-approval is supporting the claim that they made on their
validated.
application.
that's correct.
Trust but verify.
Yep.
Absolutely.
Yep. Yeah. And, we do, and you will hear, from your, client, oh my gosh, the lender is asking for these documents. And what I would tell any agent is, hey, encourage them to get those documents in sooner rather than later, because that's
Hmm.
going to speed stuff up. Stuff, that's not the right term, but that's going to speed the process up on the back end if we have those documents. And there are lenders out there that won't ask for any documents. They'll send out letters and do those types of things, and that's great. but I really would urge any agent to ask, how far along are you? What have you sent the lender, things of that nature? Because that just, again, trust but verify. It just gives you a little bit more information, and it gives the agent more confidence in their buyer and the buyer's offer, right?
No, and I
Absolutely.
agree. Like one thing when I receive a pre-approval or if I see it, I immediately read it. Did they check box that they received the documents? If that's
Mhm.
an X or a have not received, immediately for me, I'm like, hold on.
Mhm.
Like you don't really know. Like if I'm on the listing side and representing a seller, that's the first thing I go to for a pre-approval. Have they received the documents? Yes or no? If it's a no, hold on now. I'm gonna call that lender, you know?
Yep.
And this
Yep.
doesn't happen immediately. So again, why it's so important to get that turned in before you start looking so you don't find yourself in a situation where you've fallen in love with a house, there's multiple offers, and you haven't done step one yet. So
Mhm.
I love that. Thank you so much for explaining that to us, Zach.
Yeah, well, and just real quick, just back to that other slide,
Hmm.
if it's okay. I
Yeah,
did want to
absolutely.
go over the credit
Oh
approval
yeah.
kind of aspect of it, because sometimes we're able to submit files. Like I'm doing this with a couple of files here right now, where the income's a little tricky. Maybe they do have 12 jobs in the last 2 years, right? Maybe maybe they're self-employed. There's any number of reasons, but sometimes what I'll do is I'll take an incomplete file and actually send that into underwriting as a full, we call it a TBD, to be determined underwrite file. And
Hmm.
I'll actually send that in for full credit approval. And that means that we've actually already got credit approval from an underwriter. And then furthermore, once they go under contract, essentially we've already met financing contingency. Because once it's been through underwriting and we have that conditional approval on our end, that's when we've met that financing contingency for the contract and things of that nature. But getting that credit approval even before they go under contract is doable. And we do that from time to time, which is pretty cool.
That is cool. I love that. So is
So.
the credit approval protection something that's unique to y'all, or is that something that's common in the industry?
So I believe that it's pretty unique to us.
I love
We
that.
do have the credit approval protection. Basically, once we have credit approval, now this happens before you go under contract, but we
Hmm.
do this credit approval protection that we can do what's called that TBD approval.
Hmm.
And if we have credit approval before you go under contract, and then they do end up, and we're not able to close it, then we can pay up to $1,000 for the inspection, appraisal, relocation costs, and those types of things.
That's really cool. I love
I
that.
mean, it's situation to situation, but yes, that is something that we
Yeah,
offer. But that's a TBD approval before they actually go under contract.
I love that.
Yep.
Well,
Speaking of
speaking
all the
of,
documents that we were
yeah,
mentioning,
take it away,
Yeah.
Beck.
well, I mean, like I hear all the time. I mean, I know we talked yesterday, is like, if I have a buyer client, a house just went on the market, they got notified and they weren't even looking to buy. They're like, oh my gosh, I saw my dream house, I have to buy
Hmm.
it. And what do I need to do? I'm like, my first answer is like, you get with a lender and I'll send them some contacts. And then from there, like, what do you need at the minimum to just like start the process to even get them approved? I mean, we keep seeing the documents, like I know this is not an exhaustive list, but this gets us started.
Hmm.
Yeah. So right out of the gate, whenever we get a loan application from a client, as soon as we basically get everything in, they automatically get an email that requests the basic documents. Okay. And it is kind of a canned list, just based on them literally filling out a loan application. But at the very least, it gives the client an idea of, okay, this is serious. Like I need to get these things in
Yeah.
rather than waiting. And I get documents from every single client. I don't care if the credit score doesn't qualify. My end goal is to get them qualified someday, some way. So if I don't ask for documents from those people, even if their credit score doesn't qualify, I still don't have a full holistic picture of what I'm working with. So even if somebody has a 400 credit score, I'm still going to request documents
Hmm.
because I want to make sure that we don't have other things because I can fix credit. I can fix, I can't fix job history, but I can fix,
Yeah.
you staying at your job longer and saying, hey, you're going to be in great shape once you've been here for 12 months or whatever it may look like. My
Hmm.
point is, I always try to get documents. And the bare minimum documents that we try to get are going to be the last 2 years of W-2s. We want your pay stubs for the last 30 days and your last 2 months worth of bank statements and or the account that you're going to pull the funds from. So if it's a 401k a retirement account, whatever that looks like. We just want to make sure that you have the funds. Or if you don't, that's okay. Then we want to start talking about down payment assistance programs that we have to offer. It just gives me an idea, kind of a baseline of where I'm starting and what we need to do to get them into a home, whether it's now, 6 months from now, a year from now, whatever that looks like. And then a caveat to this is go ahead and get an insurance quote. Even if it's just a house you're sort of kind of like, just go ahead and get an insurance quote, because that becomes a surprise that a lot of people will maybe decide not to purchase in a specific area if, say, the flood insurance comes back at $3,000 a year, right? So, I mean, those can be things that kind of help the agents, know whether or not they want to continue moving forward with a property, is getting those insurance quotes early on. Now, the last thing I'll say about the documents from the pre-approval side is, if they don't have everything, it's okay, but we want to just make sure that they're working on those things.
Absolutely.
And I'm glad you put 1099 on here, because if they are self-employed, typically what we're going to ask for is the last 2 years of tax returns, both personal and business. And one thing that I've started doing related to any self-employed borrower is I also go ahead and ask for 12 months of business bank statements, in the off chance that we go ahead and look at a bank statement loan for those self-employed borrowers or those 1099, borrowers.
Like us, like real estate agents.
Yes, that's right. That's exactly right. Because a lot of times the bank statements will tell more of a story than your tax returns will.
Yeah.
Yeah, that makes a lot of sense. Okay, so there are a couple of the most common loan programs that we see, and the first one I wanted to talk about was conventional. That one, is that the most common? Is that the most popular, or which one are you seeing?
I'd say in Southeast Texas, it's a toss-up. Nationwide, I would say conventional is absolutely the most common. But that also takes into consideration the entire, United States. With us in Southeast Texas, it's probably a toss-up between conventional and FHA. And I can go into some of the reasons why when we get to the FHA side. It's not for any other reason other than just where we fall as far as income goes, where credit scores typically fall in. That's the only reason why you might see a few more FHA deals than when you were a conventional. But since we're on conventional now, a lot of folks, including me until I got in this business, had this false sense of what was required for a conventional loan. In my mind, Stacey, I thought 20% down.
That's what
you had to do it.
Yeah.
And look, I've been in the business. I got in the business in 2016. I don't know where the mentality of putting 20% down even came from. If that was a thing that was required, way back in the day, and maybe that was the case. But since I've been in the mortgage business, we can actually get by with as little as 3% down on a conventional loan, as long as you're a first-time home buyer. Okay.
Yeah.
A lot of people go, well, what's a first-time home buyer? Is it because I've never owned a home? Is it because, what does that look like? So a first-time home buyer, according to the federal government, is anyone who has not had home ownership in the last 3 years.
Which that's impressive. I don't think a lot of people realize that. And that's not that long of a stretch to be able to utilize some of that again, so.
That's right. So if you have not owned a home in the last 3 years, then you qualify now as a first-time home buyer and can put as little as 3% down.
Can I ask a question on that?
Yes.
How do you guys verify that? Is that someone has had a mortgage on their credit history in 3 years?
That's one way. The other way is it doesn't have to be a mortgage necessarily, but if they've been on the deed for a property in the last 3 years, then that actually counts as home ownership.
Because I was thinking, what happens if you get a probate or someone gifted you their house, and you get? I'm like, how does that pop up?
Yeah, then they technically could be considered a homeowner, which would not allow them to put the 3% down. They would then bump automatically to a 5% down minimum on a conventional loan.
Okay. That's good to know.
I see that on here. It says there's less money out of pocket for a conventional. Can you share a little bit about why it's less money for that loan type?
So that's kind of twofold. That gets into the mortgage insurance, which mortgage insurance is going to be required on all loans. And unless you put 20% down going with a conventional mortgage, then there is no mortgage insurance. Okay. Now, if you put 5% down, your mortgage insurance is going to be at, X price. If you put 10% down, it'll be at Y price, and so on and so forth. The more you put down on a conventional loan, the less the mortgage insurance is per month. And the reason why that might be less money, quote unquote, out of pocket is because with a conventional loan, the only mortgage insurance you pay is that monthly piece, okay, which is set by mortgage insurance companies. I think there's 5 or 6 of them in the United States. They pretty much all have the same rates, same things, but there are those companies that the lenders just use the same ones and request those. But it's only a monthly mortgage obligation. Okay. And you can pay your mortgage insurance up front and not have to pay any of it at all monthly, but you're still paying for it one way or another. It's called upfront mortgage insurance. But with an FHA loan, there's the monthly portion, but there's also a financed mortgage insurance. It's added to the loan amount. So at the end of the day, the loan amount might be higher or will be higher for an FHA loan than it would be for conventional because there's less. I mean, there's more mortgage insurance being collected up front that's actually financed into the mortgage. So if you're looking at it from that perspective, then a conventional, may have less money out of pocket. And at 3% down, FHA, the minimum is 3.5% down. So if you're only putting 3% down on a conventional loan, that would absolutely be less money out of pocket.
Yeah.
Sure.
No, I love that. Okay, so FHA, we were talking about that a little bit, but yeah, if you can explain that a little bit and the difference between that and conventional and why people may be going towards that right now.
Yeah, so in 2022, things kind of flip-flopped, right? Up until 2022, conventional loans had the lowest interest rates. And really, since I had been in the business since 2016, always conventional had the lowest interest rates, right? Well, in 2022, everything flipped, right? So then all of a sudden, FHA loans now have the best interest rates. And still to this day, FHA rates are lower than a conventional loan. That also goes for VA and USDA. Pretty much any government-backed financing option is going to have a lower interest rate right now. Now, that doesn't mean that's the end-all be-all. That could flip again, with the markets and what happens in the world. But it's just right now, you're going to see those lower interest rates on those FHA loans. Now, one thing just to keep in mind is the minimum on an FHA loan is 3.5% down. Okay, so you will have that 3.5% down. But one of the benefits to an FHA loan is they do go all the way down to a 540 credit score. Now, not every lender will go down to a 540, but FHA will go down to a 540 and says that 540 and above is okay. We specifically operate with folks at 540 and above all day long. One thing to keep in mind, if you do have a client that is pre-approved, but their credit score is in that 540 to 580 range, they will be required to put 10% down. And that's FHA's rule, not a lender rule. That is FHA's guideline and rule. So if you get a pre-approval and you see 10% down on an FHA, that might be a way for the agent to know, okay, probably because their credit score is requiring that they put that 10% down. So that's one thing to kind of keep in mind. Another reason why people do kind of lean sometimes towards that FHA loan is because of debt to income. It has the highest debt to income. We can go all the way up to 55% and sometimes above 55% and still get FHA approval. Whereas conventional, you're going to be capped at a hard 50%, no ifs, and buts about it. If it's 50.00001, like not happening conventional. I don't care what happens, right?
Yeah,
So
can you explain debt to income? Can you explain how that
yes.
ratio is?
Yes, great question. So debt to income is a measure of how much you have going out every month versus how much you have coming in, right? So it's not going to be like your water bill or your electric bill. It's only going to be things that are going to be picked up on a credit report. So car notes that are installment loans, revolving loans, student loan debt, collections, charge-offs, any of that kind of stuff is all going to be picked up on a credit report. We don't have to count medical payments. We don't have to count charge-offs typically. But anything that shows up as a revolving and installment loan debt is what we're going to count as that money going out each month. And then the other piece of it is the money coming in. So that's your income, that's retirement, that's any source of income or any source of money coming in. We can typically use those. And what you do with debt to income is you take your debt divided by your income, and that gives you a specific ratio. And we do one that's basically the front end ratio, and there's one that's the back end ratio. The one that we typically pay attention to the most is the back end ratio that actually includes the new monthly note and the new monthly payment in it. And that's usually what we're referring to when it comes to debt to income.
So you feel like that
So
that's a plug for why it's important to get that insurance quote in, because that insurance
that's right,
quote can swing that debt to income.
100%. It
Good point.
can. And we want to make sure that the client has the best coverage that they're comfortable with. But we also have to pay attention to it, which again, if you're on the line at 54% debt to income and the lender's using a certain amount for insurance that they're estimating, and then insurance comes in higher, to Becca's point, yeah, it can absolutely throw that ratio a little too high. So it's important to, again, get the information to your lender ASAP, encourage your clients to get the information to their lender, encourage your clients to get an insurance quote early on. If you're standing around the kitchen talking about making an offer, that's a good time, for you as a buyer's agent to say, hey, why don't we call X, Y, and Z insurance agent and go ahead and get a quote from him working, even if you're remotely interested in the property, just to make sure we're all covered here.
Yeah,
So definitely
absolutely.
recommend. And then also another reason why folks may lean towards an FHA loan over a conventional loan is, and we're going to talk more about this too, so I don't want to go too deep in the weeds on it, but with an FHA loan or a government loan, you can typically ask for more in closing cost assistance from the seller, which is kind of nice. But we'll go into more detail. I know a little bit about that later. And then one other thing I want to note, just so we take any confusion out of it, FHA approved condos. Now, there are condos that can be approved to go FHA. Here in Southeast Texas, as far as I know, we don't actually have any. And I've checked pretty recently to see if there were any that have reached approval or gotten approval. Now, that's not to say that you can't get them approved to go FHA, but in our specific area, we don't see as many FHA approved condos. Those do, however, exist in other markets and things
Yeah,
of that
maybe
nature.
maybe in the
I would say
woodlands
as
where some of
many,
our
and
agents
then
may be.
asterisk of like none at all, you know? Yeah.
Yeah,
I love
I
it.
mean,
Yeah.
but you can go through the steps of getting them approved. That is a thing. It's
Yeah.
just the likelihood of getting one approved during the lending process is not usually going to happen because normally sellers don't want to wait around for that.
I know
Yeah.
one thing that I was taught, and correct me if I'm wrong, that FHA means, I mean, just like with any loan program, a borrower has to qualify, but with FHA, so does the property. Like it can't, like with FH or like condos or things like that. It's not just like a blanket, you can go buy anything. And so I know specifically for our area, condos, 99% in our area are not going to fall under this FHA umbrella. So
That's
like
correct.
you could be approved for FHA, that's great, but if your property doesn't qualify for that loan type, then it's not going to work.
Yep, that is a fact. That is a
Awesome.
fact.
Yeah, no, and I was pulling the data for our team meeting tomorrow, and FHA is the gap is widening. It's pretty good gap year to date of how many FHA over conventional this year compared to last year.
Hmm.
So yes, that aligns with what you were saying. One that has not had quite as many is the VA, and then the USDA that we'll be talking about next. But can you tell us a little bit about the VA loan?
Yeah, we love doing VA loans. We love our veterans and active duty service members, and we do a lot of VA loans. Now, I agree, Stacy. We have not seen nearly as many VA loans, this year than we've seen in years past.
Hmm.
The benefit is if you qualify as a veteran or active duty service member, we obviously have to have the paperwork and the documentation to support all that. And just because you are a veteran or your current active duty does not mean that you have VA eligibility. So I do like to point that out. We do appreciate your service, but at the same time, there are times that maybe that veteran doesn't have the eligibility. Again, that's a plug to get documents to the lender as quickly as possible.
Absolutely.
You look at a DD 214, which is one of those documents for veterans that we have to verify and get a certificate of eligibility. And one other caveat to that, just real quick, is if they've used their eligibility in the past, we have to make sure that they have restored eligibility. You can have two VA loans at once as long as you have enough eligibility. So just because you've used your VA, loan in the past doesn't mean that you're not qualified to use it in the future. But those are things that we do have to look at as a lender. They're fantastic, zero down, no mortgage insurance, which is amazing. They do have a VA funding fee that some veterans do have to pay. If you're a disabled veteran, then you do not have to pay the VA funding fee. Sellers can actually cover all of the closing costs for a veteran. Now, not in every situation, but I have closed VA loans where the seller did cover and was able to cover all of the closing costs. Interest rates are about the same as an FHA mortgage. But to Becca's point earlier, VA does have some additional stipulations when it comes to properties and whether or not that property will qualify for a VA loan. Now that becomes kind of a whole nother ball of wax. Underwriters actually have to review the appraisals after let me take that back. Underwriters approve all appraisals, no matter what the loan.
Yeah.
But there's actually a specific checklist that an underwriter has to go through the VA and for a VA loan that's different than any other type of loan. So those are things to consider. And I know we're going to talk about that a little bit more later. But great loan programs.
Yes, it is.
And yeah, I think VA loans are great.
Yeah. And another good one, but probably the least used out of the four, is USDA.
Yes, USDA loans. Now, the property location has to qualify here. So not only does the property have to qualify, which we'll get into some of that because they have some different rules related to septic and water wells and things of that nature. But it actually has to be in a USDA rural area. And I do rural because basically anything outside for our area, anything outside Jefferson County is going to be considered, a USDA eligible area. Now, there are some little tiny pockets in Jefferson County, I believe. Don't hold me to that.
Yeah,
It's very rare, though, to find a property in Jefferson County that is going to be approved USDA. But I don't want to say that it can't happen because, hey, maybe they changed the lines, they changed the rules, whatever. So there is a USDA property lookup that, typically, I'm sure Stacy and Becca can get you that website for that. I'm happy to share that information too, just at a later date, just so you have that information because you too can search and find out if a property is going to be eligible for a USDA loan. But what I'll say is typically like Hardin County, Orange County, those areas are going to be in that USDA, area. They're great because it's 0% down. Now, I know we talked about this a little bit in prep for this, but on USDA's website, it will say 540 minimum credit score. From experience, okay, I have not seen folks with credit scores that low get approved. I'm not saying it's impossible. I'm not saying that there's not a loophole out there or a loan program through USDA that allows for lower credit. I'm just saying we have to run everything through GUTS, which is their own proprietary underwriting system that the entire United States has to use. And typically you want to see scores, in the 640, 650 range. And you want to see that debt to income that we talked about earlier, you want to see that below 50%. And again, like USDA and all of your government loans, it is going to be for primary residence only. I don't know that I've mentioned that yet, but your FHA, USDA, and VA is all going to be primary residence. They don't allow for the second homes investments. That's going to be strictly conventional.
Yeah, that's important. I'm glad you mentioned that.
Yes, for sure. And then there are income limits just while we're on the USDA. They're really the only loan program outside of down payment assistance programs that have that income limit. And they do update that every year. Right now it's at 119,000 for a 1 to 4 family because you take in all of the income associated with a household. Even if those folks aren't on the loan, you still have to account for their income. And then 5 to 8 people is at 158,000 and some change. But anyways, USDA loans are great. They're wonderful. Just a little bit harder to get qualified for.
Yeah, I love them. I've done a few, but not a ton.
Zach, and the income limit, is that everyone over the age of 18? That's not like
Yes.
a 16-year-old that
Yes.
has like a
Yeah.
summer job, right?
No, it's 18
Okay.
plus that are
Okay.
living in the home.
Cool beans.
Okay, so there are closing costs that are included versus excluded we were going to talk about today. And I know that we, again, speaking, going back to the managing expectations, that in the buyer conversion conversation of kind of preparing them not only to talk to the lender about what closing costs are, but to explain to them what they'll be responsible for out of pocket up front with option fee, earnest money, inspection costs. Can you talk a little bit about some of those closing costs that, what's involved in that and what's not, maybe?
Yeah, so this is a common misconception, and I've seen it be misunderstood from seasoned agents all the way to the newest agent. And it's not for a lack of necessarily understanding, it's the terminology can get a little bit interesting, and
Mm-hmm.
different lenders will say different things. So it's not even entirely on a misunderstanding from an agent perspective as much as
Mm-hmm.
it is, I think, poor training from a lender to an agent perspective. Okay.
Gotcha.
Closing costs can mean a whole lot of things,
Yeah.
right? Whenever I am talking about closing costs and when I have conversations with agents and buyers, my conversation goes a little bit differently. So, your closing costs are going to be the fees associated with getting the loan. Okay. So, in order for you to get a loan in the state of Texas, typically, now this is typical, there are exceptions to every rule, but I'm just going to cover from a broad, perspective. You're going to have an appraiser is going to go out to the property. He's going to
Mm-hmm.
determine market value. His job isn't to check for functionality, it's really to check market value. Okay. He's going to go to the property. That is a cost associated with getting a mortgage, getting a loan, right? So that would be considered a closing cost, right?
Yep.
Any rate buy down, okay? And to try not to get in the weeds, rate buy down is essentially just buying down your interest rate. You can do it, you don't have to do it. A lender can give you the option to do it, not give you the option to do it, whatever, okay? But for this conversation, we're going to call buying down the rate part of the closing costs. Okay.
Mm-hmm.
So that would be part of the closing cost. And then you're going to have, say, a credit report fee, closing cost. It costs me money to pull a copy of buyer's credit report. That's going to be a pass through from fee from me to them at closing, right? And
Mm-hmm.
then you're going to have the lender fees that are going to be, underwriting, processing, closing the loan. You'll see a whole bunch of things depending on the lender that roll into that. I call them lender house fees on my spreadsheets that I send out, and I just explain to the clients exactly what those are. They will be itemized on a loan estimate or a closing disclosure, but you're going to have those fees. And then after that, you're pretty much going to have all title fees. The client's going to close at a title company. A title company is going to do their due diligence and do their homework to ensure that the client is going to own the home outright. And they also issue a title insurance policy. Now, there's a lender's title policy and there's an owner title policy. One of those, which is the lender's title policy or the owner's title policy, is like $100, and the other one ends up being, a couple $1,000 usually. Now, that piece can be negotiated. Who's going to pay that title policy? Sometimes the seller covers it, sometimes the buyer covers it, but that would be part of your quote unquote closing costs. And then I always like to bring up the fact that you may or may not have to have a survey. That can be something that is necessary if they don't already have an existing one that's approved by title, but that's also considering a closing cost. Okay. So that's really your closing cost in a nutshell. Okay. Um, Outside of the closing cost, you've got your down payment, which is going to maybe be 3.5% on an FHA loan, 3% on a conventional loan, or whatever the client wants to do, right?
Mm-hmm.
Sometimes they decide they want to put down 15% on an FHA loan for whatever reason, right? So
Yeah.
that's not considered part of your closing cost. That's separate from your closing cost. And then also, and I know on this document, it's showing prepaids and escrow reserves. While it can be considered part of your closing costs, depending on who you're talking to in the process,
Mm-hmm.
for me, I like to phrase that a little bit differently, as that is your insurance and taxes that we're collecting as the lender to put into a bank account that's for them. Because at the end of the day, it really is their money. If they
Mm-hmm.
sell the home, they're going to get whatever's in the escrow account at that particular time. Same thing if they refinance the home, they're likely going to get credit for that if they're using the same lender. If not, we'll reset up escrow, but they still get a check in the mail after you close on a refinance, typically 15 to 30 days after that, and you get those funds. But it is important to note that your total cash to close number includes the closing costs that I outlined earlier, your prepaids and escrow, which is your taxes and your insurance that you're putting in this account,
Mm-hmm.
plus your down payment equals your total cash to close, which is a lot larger number than, say, just what the closing costs would tally up to, or the escrow account or the down payment in by itself. And then kind of just because at the bottom of the slide, it talks about the seller can contribute.
Mm-hmm.
Depending on the loan program, there's going to be a percentage that they can contribute. But typically, what we're doing as a lender, just so you know how the sausage is made, we take your cash to close number and then we just subtract out what the closing cost assistance is.
Uh-huh.
And then that usually ends up being what your cash to close number needs to be. Keep in mind that your buyer is going to get credit for their earnest money deposit. But please, 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 for all the things, make sure you get a cashier's check or a check for the earnest money, something that can be
That's a
tracked.
good
Let's
point. Yeah.
not use a money order, no
Yeah.
money orders, okay? And no cash.
Yeah.
Like, and if they're getting, and always please ask, and maybe I'm going a little rogue here, but please ask if they're getting a gift for the earnest money because it matters. No matter what the loan program, it always matters where we get money from. So please, as a buyer's agent, just
Yeah,
maybe
I was
ask
gonna
those questions.
asterisk
I
that by
love that.
saying, yeah, like for sure. If you have a random business account, if it's mom or dad or you weren't paying attention or whatever, if that check or cashier's check comes from someone other than you, they're gonna be like, I need to source the funds, and like
Yeah.
where did this come from? What do you
Yeah.
mean it came from your cousin's account or uncle or mom or dad or this business account? And you're like, what? Yeah, so make sure that it just doesn't arbitrarily come from, oh, I didn't have the money at the moment, so somebody fronted me my $3,500. It
Yeah.
complicates things very quickly.
No, definitely. Y'all are
Yes.
making great points. And another really important reason as to why communication matters so much up front whenever you're talking to your clients at the beginning. Okay, so y'all were
Yes.
talking about seller's concessions and what is allowed. This sheet kind of explains it a little bit more in detail. If you want to talk a little bit about that and why it has the 3-2-6 or 3-9 on some of these.
Yeah. Yeah, absolutely. So um it's a little bit interesting the way this spreadsheet's kind of laid out, but just for the nuts and the bolts of it, I'll just go through conventional kind of just on its own. So conventional is a little bit different in that if you put down 3%, 5%, 9.99%, the max closing cost assistance that you can ask for from the seller is going to be 3% of whatever that purchase price that you agree on is. Okay. But then once you hit 10%, all of a sudden 10% all the way down to 20%, you can ask for 6% in closing cost assistance. And then once you go to 25% on conventional, then you can ask for up to 9% in closing cost assistance. So just kind of keep that in the back of your mind as far as when you're looking at those conventional options. And
Mhm.
when you're thinking about how much you're wanting to put down, you can limit yourself as far as what you can ask from a seller um, based on how much you're willing or able to put down. And then I will say with the caveat, we hardly ever see anybody get the 9% because likely the 9% is going to be way too much and the lender's
Yeah.
not going to be able to use all of the closing cost assistance.
Hmm.
And just kind of to that point, when we're talking about closing cost assistance, you want to make sure from a buyer's agent standpoint that you're actually requesting what maybe should be requested
Hmm.
from the seller in closing cost assistance so that you're not asking for too much. Because I have been in a situation where, maybe the client and the agent talk and they ask for a full 6% on a $500,000 home. Well, 6% on 500,000 is a lot of money.
Yeah.
And there's likely not going to be enough closing cost, escrow, and anything else, I mean, to cover, right? To cover, I mean, it's the number's not going to be big enough. And then if you ask and negotiate 6% on 500,000 and we don't use it all, then all of a sudden the buyers get a little upset when they realize they just left that money on the table because it goes right
Yeah.
back to the seller, right?
Yeah.
Because it's not like they get that money. So, when you're working with a good lender like the Royal West Team and Go Mortgage, we might advise you beforehand and go, hey, like, if you want to ask for 6%, great, but we're going to have to get creative. And we can get creative. I don't want you to think that we can't. We can get creative. We can use it to buy down the interest rate. I've also had agents say, okay, we'll get another year or two of home warranty. So we can use it for those things. But you really don't want to ask for too much, because then all of a sudden you are putting yourself in a situation where if you leave money on the table, that buyers aren't usually super happy about that.
Yeah.
Um,
Well, no, and I
so
think that that's a
just
great point because like using too much of that you're not going to necessarily need could hurt you in another place where you're trying to negotiate, like for repairs or something, where they're like, I don't want to give you all this and everything you asked for here. You know what I mean? So knowing how much you can use and what's available is really important. I love that you brought that up.
Yeah. And typically I'll try to, you want to, from a buyer's agent perspective, if the lender isn't sending you the estimates, and
Hmm.
not every lender is going to have it top of mind. And I try to send it, the, the estimates to the agents every single time. But I'll be honest with you, it's hard to remember to copy everybody all the time on everything, especially when
Hmm.
you're just like sending out initial numbers to clients and whatnot. But I always do try to forward those to the agents so that they know what I'm looking at as far as numbers go, so that they can negotiate for the best deal for their client. So that is one thing. If you're not getting the loan estimates from the lender, just ask them. They're going to send it to you so that you can see and know. Because if you may have questions about, hey, why are we asking for this much in closing cost assistance? Do
Hmm.
they really need this much in closing cost assistance?
Absolutely.
So that's one thing to consider. Now, back to this specific slide, conventional is going to be a moving scale for how much you can ask for in closing cost assistance. FHA, you can ask for 6%, no matter how much they put down. VA, 4%, but keep in mind there's asterisks there for a reason. Usually, as long as the purchase price is high enough, the seller can cover everything for a
Mm.
VA loan. And then USDA, again, it's going to be at 6%, no matter how much they put down, or zero down, because USDA is zero down and so is VA.
Awesome. Thank you. Yeah, I always advise agents to keep a picture of this with them because it's something that I always sometimes would mix up numbers with. So I love to be able to have something to reference back to. So thank you so much.
Yep.
Okay, Beck, do you want to share this as to where it goes in the contract?
Yes, and your uh especially like the I don't want to say standard, but the most commonly used, it's going to be the TREC 1 to 4 family residential contract. It's going to be paragraph 12A, and it's going to be paragraph B. It's the only input field in paragraph 12A, and that's where you're going to convert. You'll have to do a little bit of math. So it's percentage based on the amount of concessions that they can ask off of the sales price on that loan type. So you'll have to do the math of it. If you're going to ask for 3%, 2%, 5% based off your loan type, multiply it times your sales price, and then you're going to put that there in paragraph 12A and then B for that section on there. And that is specifically for the seller's concessions, whether you guys want to call it concessions, closing cost assistance, CCA, like it goes by many names, but that's how much the seller is giving towards the buyer to cover the buyer's expenses. Like Zach said, like appraisal fees, credit report fees, escrow fees, survey, whatever it is, like that's going to go towards their credit for their cash to close at closing.
Awesome.
Yep.
Thanks.
Yeah, that's correct. And please, if this number changes at any point,
Hmm.
please make sure the lender is made aware. It
Yeah.
may seem, common sense to you as the buyer's agent, but I can't tell you how many times that this number changes or gets renegotiated, either before or after, inspections,
Hmm.
before or after appraisals. It just changes and it moves. And if we don't have the amendment knowing that, then sometimes it can create surprises on the back end if you've talked to your client about getting this, but maybe the lender wasn't kept in the loop, or maybe it's just forgotten. And things happen. Excuse
Yeah,
me.
absolutely.
Things happen all the time, and numbers change all the time. But sometimes it can be a little bit of uh-oh, and it causes a lot of issues on the back end. So just please make sure you're always communicating if this number is going to change, because clients are paying attention to their bottom line like crazy. And
Hmm.
if the lender's not kept in the loop about a change that was made after, or before, or during inspections, and we send out a disclosure and it's different numbers, that oftentimes makes it look like the agent and the lender are out of sync. And
Yeah.
that's just not the best customer experience. So just, when things change on our side, if we're changing loan programs and things of that nature, it's our job to communicate to you. And any changes on the numbers or negotiated things after inspections and appraisals, just please make sure you're always communicating that.
Yeah, and I would say the
Agreed.
lender and
I
the
was about
title
to
company.
say.
Because
Yep.
Yes, yes,
when you guys go to like on the back end, you guys are balancing numbers, and if one of the parties has it and the other one doesn't, they're
It
like,
can
"Well,
feel
I've
like
got this
that.
credit that's higher or lower," and the other one's like, "But I've got this credit higher or lower," and then you're like, "Our numbers don't match." So
yep,
everyone needs to know.
yes,
Yeah, and I
yep,
love that y'all brought up, I mean, the overall client experience, because we always talk about, the value is in more than just that one transaction. And so you definitely don't want to drop the ball and make the experience any less than it could be just by a mistake, something little like that. But not little, but you know what I mean, just not passing it on like you should.
yep.
I love that. Thank y'all so much. Yes. And I love that you also brought up as far as after repairs sometimes, because there are times that people will negotiate funds in lieu of repairs, and that can also go there to what Becca was talking about. So thank you
Yep.
guys. Okay, so speaking of inspections and negotiating repairs, we're going to talk about the loan specific inspections and some of the lender required repairs that you guys may have to navigate whenever you're under contract on a transaction. So there's different ones like Zach was talking about earlier for different loan types. Can you share a
Mhm.
little bit about some of that, Zach, that a lender may require on certain government-backed loans that they wouldn't necessarily on conventional?
Yeah, absolutely. And we can talk about lender required and appraisal required. Do you want me to kind of talk about both right now?
Both. Yeah, no, I think that's great.
Okay.
Yeah. And if
Okay.
we reiterated on another one, that's okay.
Okay, perfect. So, typically with an FHA, VA, or USDA, there are going to be some different things an appraiser may or may look at or is supposed to look at.
Hmm.
Okay. So, eh, for both of them, what I tell people is if there's a safety issue, it's going to get called for both. Okay. If there's exposed wires, I don't care if it's a conventional loan, FHA, VA, USDA, like it's going to get called. So, just
Yeah.
as an agent and you're a listing agent, you want to take care of those things because it just means there's less things that you're going to have to jack with on the back end. So, like anything that looks unsafe, just assume that appraiser is going to call it because they're not going to put their license on the line for not calling something that looks unsafe. So, if it looks unsafe, it doesn't look healthy, like probably want to go ahead and address that before you list the property,
Hmm.
or know that it's going to absolutely get called no matter what the loan program is. Okay. And one other caveat that I'll say for government and conventional loans is there used to be a larger separation in appraisals and appraisal requirements for these types of loans. So a conventional loan, you may have been able to slide by with certain things, whereas on an FHA, you might not. And there's still a little bit of that. I'm not going to say it's totally gone away, but they are getting a lot closer
Yeah.
together, right? I mean, I have seen, for an example, historically, rotten wood peeling paint, right?
Hmm.
Everybody's like, oh, if it's FHA, you got to get all that taken care of beforehand. Yes, I would recommend if you have the budget and the ability to do it, just get it knocked out because it's
Hmm.
easier to take care of a lot of times on the front end than it is getting called by the appraiser and the appraiser having to go back out. And then you
Yeah.
have a
Extra
final
fees.
inspection cost because an appraiser is not doing stuff for free,
Yep.
right? So if they have to go back out to a property, they're going to charge a trip fee, all the things. So that kind of stuff, no matter what. But I will tell you, I've seen rotten wood peeling paint get called on a conventional deal, and I've seen it not get called on an FHA deal. Because the thing to keep in mind a lot of times is it structural or cosmetic? If it's structural, there's a chance it's going to get called on both. If it's a structural, it's absolutely going to get called on FHA. Sometimes, if it's just cosmetic and it's on the garage, I've seen FHA appraisers let it go, right?
Hmm.
On a conventional loan, appraisers aren't looking at the rotten wood peeling paint as much, but if it's structural, they're going to call it. So I
Hmm.
will tell you that it's not like a rule that's like yes one way, no another. You really have to look at where the rotten wood and the peeling paint is.
Hmm.
VA is going to require a termite inspection. The buyer or seller can pay for it. Okay. So that's one big difference. FHA does not require a termite inspection. So it's not mandatory. I recommend obviously everybody get an inspection,
Absolutely.
everybody get a termite. As
Mhm.
cheap as a termite inspection is, there's no reason not to have it done on a conventional loan. But VA, you actually have to submit it to the VA portal and they have to review it. And you
Absolutely.
can't have any conducive conditions. So
That's
this
what I
is
was
one
about to
thing that
say. That
pops
word
up.
sticks up. That's where
Yeah,
I learned it.
conducive conditions. Okay. So if you have one done and they mark conducive conditions to the little termite critters,
Mhm.
you got to get those taken care of. And we have to have a new, not a new report, but an updated report stating that the conducive conditions have been taken care of. Sometimes the inspector will go off of pictures. If you send in pictures showing the foliage trimmed away from the house, because that's a conducive condition that oftentimes gets called. They'll
Mhm.
sometimes send you a new report, sign off on it, good to go. But if you have conducive conditions, rotten wood, fences leaning up against the house, foliage leaning up against the house,
Yeah.
branches that are touching the roof, like
Mhm.
they're going to get called every time on a VA termite inspection as conducive conditions. So just make sure you're paying attention to that. And then well and septic inspections, usually going to be more prominent on a VA or USDA loan. FHA, every once in a while, depending on the appraiser, depending on the underwriter that you get, sometimes they're going to require certain things when it comes to FHA, but not as often as you're going to see it on the USDA and VA. If it
Mhm.
is not on city water or city sewer, likely going to have some type of inspection. A lot of times they're going to want on VA, they're going to want the well water tested.
Mhm.
And there's very specific rules when it comes to that. It's not just about going and filling up a water bottle with it and running over to your local,
Yeah.
testing facility. There's specific things that have to be done. And then on the septic, a lot of times what I see is they have just not, the maintenance hasn't been kept up or it hasn't been pumped
Mhm.
in a while, and those will get called every time. On conventional, you're not going to have to typically worry about a well and a septic. Um, Termites not going to ever be required. They are a little bit, as much as it pains me to say this, because I don't want to, you know, enforce any type of major difference between government and conventional loans. Every once in a while, you will see an appraiser being a little bit more lenient on certain items on a conventional loan,
Mhm.
but I wouldn't bet on it. I would, if it were me and you have the ability to do it, try to just go at everything as if it's just a blanket appraisal and you need to take care of all the things. That's
Yeah.
just going to save you headaches on the back end, especially if it catches a seller off guard. It's probably better just to communicate to the seller, like, hey, we probably want to knock these things out
Yeah.
um, when it comes to that.
And back, you brought up something yesterday whenever I mentioned the lead-based paint assessment, and I was like, there's an addendum, but I'm not seeing an assessment. And can you just reiterate what you said yesterday as to when that may be
Yeah,
necessary?
I mean, this isn't probably super common on the lead-based paint addendum. The seller has two boxes, whether they're going to check yes that they are aware of any reports or assessment or lead-based paint. And I'm sure this would be triggered if a seller marks yes, and then it goes to the lender and the underwriter, and it's one of these governmental loan programs. They're going to have to see if there's an assessment, depending on how what the seller discloses and any reports that they have accompanying their answer to yes, for the reports or assessment or remediation or whatever it is that they've already done for the lead-based paint. And so there could be a lead-based paint assessment depending on how the seller answers. In my experience, it hasn't been very common, but it's not off of the realm of possibility.
Yeah, thank you. Yeah, when I
Yeah.
read that yesterday, I kind of scratched my head, and I just wanted to make sure and like I said, mention that again because we do use that addendum a lot, but it's not often checked yes. So thank you so much for going deeper on that one as well.
And yeah, one thing I'll say too, just related to the FHA
Hmm.
specifically and VA, really government, I should just say government in general, there are some weird rules, right? So, like if you're in a conventional loan and for whatever debt to income all of a sudden gets moved over 50%, and now you need to flip it to FHA, it's more difficult to go from a conventional loan to an FHA loan than from an FHA loan to a conventional loan. And
Hmm.
the reason I say that is because conventional to FHA, now all of a sudden you've got to get an FHA appraisal, which not all appraisers are licensed for FHA appraisals. So if the guy who did the conventional appraisal is not licensed through an FHA, you may have to pay for a whole nother appraisal because you're going to have to get another licensed FHA appraiser out there. Second of all, they have some interesting rules when it comes to like how close the house can be to a gas station or how close house can be to, the septic system, or how close it can be even to like an oil pump or power lines or things of that nature. So there are some oddities that come, and that's not just FHA, that can be USDA and VA. So if
Mhm.
you find yourself in a situation and you're a buyer's agent and or a listing agent, and all of a sudden, that information is being relayed to you that we could be looking at switching loan programs, those are all things to just take into consideration. It's just not guaranteed that you're going to go from a conventional loan to a government loan, for sure.
Awesome.
Absolutely. And I like that it mentions here on leaky or defective roofs and the life expectancy left on it, because we have for the last several years been talking a lot about roofs with Rita and Ike roofs getting called. And while agents are getting much better at negotiating for a new roof in the option period, or listing agents are kind of managing expectations of what they might have to do to be prepared if you guys do push it, that if it comes down to the appraiser, they could still call that if the life expectancy is not looking like there's very much on it, right?
That is 100% correct. And I would like to bring up at this point, at this time too, that just because you have an appraiser that does an as is appraisal, and
Mm-hmm.
it doesn't matter what the loan program is, to be totally honest with you, it
Mm-hmm.
can be FHA, conventional, whatever. Just because an appraiser says that the appraisal comes in as is condition, that does not mean that an underwriter is still not going to review the appraisal and look at the pictures. And
Mm-hmm.
if the appraiser is taking pictures of like terrible things
Mm-hmm.
and the underwriter sees those, the underwriter has every right with the lending company to call for lender repairs that may not even be appraisal repairs. So there is a difference between lender required repairs and appraisal repairs. An appraiser can go out to a property and say, hey, these things need to be done, in my opinion, and an underwriter is always going to back the appraiser when it comes to those. But there
Mm-hmm.
are times when an appraiser may not agree or may not have submitted something as subject to, and an underwriter all day, every day can go, hey, I get it. You didn't call this, but this looks terrible, or this looks like mold to me. Either get better pictures or we got to get this assessed. So
Mm-hmm.
an as is appraisal is not necessarily the end all be all. It's absolutely likely the most important and the end all be all, but there are some caveats. So
Mm-hmm.
you know, just know that. Um,
And I'm glad that you brought that up, because I mean that's something we're always, whenever you know that there's an appraiser out, they've come, we're waiting for it to come back. So as soon as you hear it's met value as is, you're like, yay! And then if it comes
yeah,
through and that something gets kicked back, because I usually try to tell you like, it does still have to go through underwriting, but I feel like a lot of times as agents, and I've been guilty myself, your ears kind of turn off like you heard what you wanted to hear and you're excited. But so until
mhm.
you have something kicked back like that, I don't think that it always sinks in that that's a possibility. So I'm glad that you really brought
it
that up.
And it doesn't happen very often. So you can still
Yeah.
get excited about as is appraisals that meet
Yeah, but
value.
just,
So I'm not saying don't be excited,
yeah,
but there
cautiously
is this,
excited.
yeah, there is an off chance that something still could get called, especially on a VA. Because, like I said earlier, there's actually a VA underwriter checklist.
Hmm.
It's called an NOV, it's called a notice of violation. And the underwriter has to go through that checklist and make sure that the appraiser actually, it's kind of like check the checker, they have to go through and make sure that the appraiser actually checked everything and did everything on their end, per VA's guidelines. So that's one of those instances. A lot of times we won't even release the appraisal information until we get the NOV back on a VA deal, because I don't want to give that false sense of security.
Absolutely. Okay, so you mentioned this a little bit earlier of the main things that they are looking for, safety, security, and soundness, basically. Is there anything else that you would want to add on this page before we move on to the next steps?
No, just anything safety related, health related. Those are all going to get called. As a listing agent, just have the conversation with the seller, get those things taken care of beforehand as best you can, because appraisers are out there and their license can be on the line if they don't call safety issues and things of that nature. Um, so just be on the lookout and just make sure, if you wouldn't want to live there, if you'd be worried about your kid potentially getting hurt, then you probably need to address it.
Absolutely. Thank you. Okay, and handling those repairs while we're under contract. Beck, do you want to talk about that and how they may go about handling those repairs in the best way?
Yes, my biggest thing is it's like the very first sentence for a buyer or a seller, regardless of what side that you're on. The first 4 words, 5 words, it says, unless otherwise agreed in writing. So it can
Mhm.
be the lender can call it from underwriting. The appraiser can make it subject to, and it could be anything big or small. It could be an outlet, a roof, a conducive conditions for term rights, whatever it is, unless it's agreed in writing by both parties. Neither party is obligated to pay for lender required repairs. And so I know sometimes there's a misconception if something gets called, like one party or the other is on the hook for
Yeah.
paying for it, and that's not the case. It's an agreed upon term and negotiation in the contract. It can be one party or the other. It can be split down the middle. It could be any variation of splitting it 60-40, 70-30, whatever it is, or they can agree to not agree and then it terminates, if neither party is willing to fix whatever the item is. Um, and that would be on our amendment to the contract. And then that gets sent over to the lender and title. And then they would proceed as normal. And then the completion of the repairs and treatments, depending on what it is going to have evidence of support and or pictures if it's something really, really major. I know the lender's going to want pictures of like the status and how it's been fixed. If it's a roof or foundation or whatever, not just like a little handwritten receipt, like they're going to want evidence. Or I know Zach will speak to this, like sometimes they'll have the appraiser go back out and re-inspect, especially if it was subject to from the appraiser. The sometimes an appraiser will be satisfied with pictures or a combination of both, whether it's the lender or the appraisal, they have to go out for an actual in-person re-inspection.
Absolutely.
Yes.
And as an agent, I think how important it is. I know it talks about here of having someone that is licensed in that or practices it commercially, but to make sure from a buyer's agent perspective that you are, whether it's lender required or not, that you're getting photos, that you're getting receipts, invoices for all the work done and keeping it. Because if they call back and they're unhappy after closing that something was done in a way, that's now broken or not working, that you can point them back to who did those repairs. You know what I mean? Because nobody wants to be the person that they're angry at after the fact that it's done. So definitely cover yourself by getting those. Uh, I love it. So, third party financing addendum, and I know we had moved this up to talk about it here, aligning with
Mhm.
that. So if you want to keep talking, Beck, just about the property approval.
Yes, it says if the lender, if the buyer's lender determines that the property does not satisfy the lender's underwriting requirements for the loan, it says including but not limited to the appraiser, or the appraisal, the buyer may terminate this contract. And I think that reiterates, like you could have an appraisal that comes in that's as is, met value, whatever, and we get all excited. I personally had one with my own transaction. It came in and then like the processor sent it out, but then it got to underwriting and they saw the picture like, whoa, 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 wait, we see some pictures here and we need an explanation. And so that was a few weeks ago. And so you've got property approval for various different reasons. For a property to qualify. Again, it also goes back to whatever loan type that they have. Like this is not just for one or more loan program on the third party financing. It's for all of them, and all of them could have property approval conditions. And I feel
Mhm.
like Zach's probably going to see it more than I ever would on what is by definition property approval, or what do you most commonly see that
Yeah, what's the situation?
unqualifies, I guess, or red flags a lender that says, hey, I don't think the property is quite ready for property approval.
Great question. We do see this from time to time because as a lender, us specifically, so the properties are rated in different types of a different category type, right? So you have a C1, C2, C3, C4, C5. We have to have a property in C4 or better condition. Okay.
For any loan
So
type, right?
any loan type, doesn't matter. Conventional, I don't care. It has to be C4 or better condition. And that's more of an appraisal, term, that condition. But I have a prime example right now working on a refinance for somebody. Appraisal came back at C5 condition. I mean, the house is a wreck. I mean, it's missing walls, it's missing flooring, it's got exposed electrical, it has a burned house on the property as well, like next to it, an outbuilding that's burned up.
Nice.
So the appraiser came back and said, "Hey, this is C5 condition." Well, we immediately said, once we got the appraisal report, we either need to bring it into C4 condition and the appraiser needs to tell us, and they're still working on it right now, what needs to happen to get it to C4 condition, or we can't lend on it because of the condition that the property's in. So I have seen it happen where property can be in such bad condition or disrepair that an appraiser can appraise it all day long. But if they say it's a C5 condition, like we have to get it to C4 condition. And that usually, not usually, that means they have to do whatever needs to be done before we can lend on the property. So one of the things that comes up the most, I would say, when it comes to property approval, and this is going to sound crazy, but and flooring.
Mm.
Incomplete flooring.
People, yeah, I
Tearing up
mean,
flooring and leaving it like
leaving it
concrete.
exposed, yeah,
Yeah.
leaving concrete exposed, leaving the tacks for the carpet. I mean, all that stuff. Like, I
Hmm.
don't care what the loan program is. A lot of times that's not going to be approved. Now, if they throw some stain on the concrete and they make it look finished, like, okay, great.
Yeah.
But if they have left things that are unsafe of that nature, but it's wild to me how much flooring does come up as far as a question, you
That's
know?
interesting. Yeah.
Um, and then a lot of times we're going to require additional inspections if there's, mold, looks something like mold or water spots, things of that nature. So those are things that even if an appraiser doesn't call it, an underwriter is going to call it because those things usually look pretty bad in pictures. Now we can sometimes get around those if we get an additional explanation from the appraiser explaining exactly what they saw, because you got to remember an underwriter is not there physically at the property.
Yeah.
But our goal is to get our clients into the home that they want to buy.
Hmm.
So if there's a way to make it happen, we're going to try and make that happen legally and all the things. But just know that if there's property issues or appraisal issues, or they take pictures of these things, like those are automatic things that we're looking at. So just keep that in the back of your mind.
Just to verify, because we were talking about the C1, C5, whatever. So just to clarify, C1 is the best condition and
Mhm.
C5 is the worst?
That's correct.
Okay.
Yep.
Just make sure.
Yep. Yeah. No,
Thank
that's a good point.
you. Okay. So again, we were just talking about property approval, but this is buyer financial approval. And whenever you are writing a contract, the third party financing addendum that goes with the contract, you're gonna have to fill out the loan type and give them an allotted amount of days to gain financial approval. So can you share a little bit about what's a reasonable number of days? What do you typically see? What kind of goes into getting them financially approved as a buyer, not just the property?
Yes. So typically I would say, 21 days to get credit approval. So credit approval or financing approval for us means it's been to underwriting. We have credit approval. And then that's usually when my team sends out the emails to the buyer's agent and the listing agent saying, hey, congratulations, we have credit approval. Becca brought up a good point yesterday that if you have like a 45 or a 90-day close, you probably want to give a few more additional days on that financing contingency,
Mhm.
just because that's such a long period of time for things to stay exactly the same.
Mhm.
So that wouldn't be uncommon to see a longer amount of time on those longer close dates. So those close dates are farther out in the future for sure.
And for a buyer's agent, if the lender doesn't send you something before this amount of days is up, because of course, ideally in the perfect scenario they are, but we're trying to protect our clients' earnest money and things like that. Um, should they be on top of it? Should they be reaching out to the lender, following anything, or looking for any specific words? I mean, like if you send out an email saying they're conditionally approved, does that meet
Mhm.
this qualification or no? And not to go
So
too much of a rabbit hole, but just for somebody new.
no, from everything that I've ever learned and done, it's always once we send out credit approval, you've met that financing
Mhm.
contingency. Um, I would say we actually track it in our system. We have financing contingencies for every single file that we do. It's on my calendar. So
Mhm.
every day I'm looking and making sure that we're meeting financing contingency. If for whatever reason we get close to that date, there are times that I will reach out to an agent and say, hey, the buyer's agent, hey, can we, get a couple extra days? They're self-employed, whatever. They're having difficulties getting us documents, to try and extend that without busting that financing contingency,
Mhm.
because you don't want to bust the financing contingency for all of the reasons, because you want to make sure you're always protecting your client's earnest money.
Absolutely.
Um, but I would say if I always enjoy it when both parties are paying attention to it.
Yeah,
When the buyer's
absolutely.
agent's reminding me and I'm, reminding them, then usually that partnership's a lot better.
Absolutely. And I love that you said that you do track it and reach out to them because again, that goes a long way with having a trusted lender that's communicating with you as well on it. So thank you so much. I love that. Beck, you have
Yep.
anything you want to add to this, sister?
I was going to say, especially for any newer agents watching this, I think it also is important to note that as you are coming into transactions on the buy side or the listing side, and you're getting closed transactions under your belt, that if you had a great experience with a great lender, like with Zach and his team, it's very important to know, like, do not rest on that experience as it being the standard for everybody else, because what you might think is, no, oh, well, I did a deal with Zach, whether you're on the buy side or the sell side, the listing side, is that's not going to be the experience for everybody, and not every lender is the same, operates the same, pays attention to deadlines. Like, this is one of the most important deadlines, especially if you're on the buy side, that if you
Mm-hmm.
have a lender that's not being aware of this deadline, to, because it's
Mm-hmm.
not just my client, it's our client. If I'm a buyer's agent,
Absolutely.
that is his borrower and that's my buyer client.
Mm-hmm.
And so protecting their money is important to both of us, because if for any reason they lose their earnest money for this provision and they want to go buy, like if their earnest money was $3,500,
Mm-hmm.
like some people, they don't have $3,500 to
Just throw
lose
away.
every
Yeah.
single time. If their money is tight or funds are tight for the next house, they're going to have to do inspections, appraisal, possibly survey all over again on top of losing their earnest money. So I feel like it's paramountly important to make sure that you are working with an experienced and trusted lender, because you're not always going to get the same experience everywhere. And if it's just you managing timelines and expectations and managing the importance of securing the buyer's potential loss of earnest money, you need all hands on deck. And so it's really important that your lender also finds value in protecting their borrower's earnest money, or the money that they stand to lose if it doesn't work out.
And can
Yes.
you go one step further? He talked about that he may reach out and say, "Hey, can we get a couple more days?" How can they do that if they put in a certain number of days here and we need a few more days?
You in a minute.
Thank you.
Every single term in this contract that has needs change. I don't care how big or small. It is not an agreed upon term unless you use an amendment to change those terms, and it's signed by all parties.
Amen. Thank
That's
you.
it.
Okay. So now the next step is appraisal, right? And if the appraisal came in low, then what happens? What does that mean for us? And this on the left-hand side is the third-party financing addendum, right?
Yes, for FHA
Oh,
and
they're both of them.
VA
Yeah,
loan
it's zoomed
types.
in. No, on the
Mhm.
right-hand side is the amendment concerning right to terminate due to lender's appraisal. So on the left-hand side, if it that would go for VA loans, FHA loans, government-backed loans, right there, that you would write in the amount that you are expecting the property to appraise for as far as the sales price. So up higher in the third-party financing addendum, you'll put the loan amount. Here, you want the total agreed upon sales price because we don't want to let it appraise for less than that, ideally, right? So if it doesn't appraise there, we would get to renegotiate.
Mhm.
And I know Beck had talked about it yesterday a little bit, but it doesn't mean like one can pay more, one can pay less. They can meet in the middle, or they may not agree at all, right?
Yeah, I like
Yep.
how Zach, like he said, there's four options,
Go for
and
it. Yeah, Zach,
yeah.
tell us the four options. I
Tell
love
us,
how
tell
you
us
said
the
it too.
four.
Yeah, I mean it's four options and you just said them, but yeah, you can if say it appraises and it comes in low, we can only lend on the sales price or the appraised value, the lower of the two. So if it's a $200,000 house and it appraises for 150, we're only lending on the 150. So the buyer can bring $10,000 difference to meet the 200,000. Everybody is happy and moves forward. That's $10,000 out of their pocket to meet that, to make that difference up between the financing and the purchase price, right?
Mhm.
Or the seller can lower it $10,000 to the appraised value of 150,000. Or I'm sorry, I think I said 150, 200, whatever. My point is 100. Let's start over. 190,000, and it's a $200,000 house. They can bring the 10,000 in, and everybody can close, or they can lower it to the 190, and we can still finance, at 190, and everybody's happy and everybody's good. Or say it's 200 and it's 190, they can bring the $5,000 a piece difference and meet in the middle. Or the last option is just walk away completely because neither party can agree to whatever they want to agree on. So, yeah, really four options: lower the price, meet the price with buyer funds, meet in the middle, or walk away.
Absolutely. And so while the third party financing addendum covers the government backed loans, it does not cover conventional loans. And so in the situation where you're writing an offer for a conventional loan type, you'll want to attach the addendum concerning right to terminate due to lender's approval. That's something that whenever I first came in and started being a practicing agent, had no idea about that form. I remember I was, shadowing people and watching them do it. And then when I first had to write one, somebody stopped me, thankfully, right before I submitted it. But it's like, that's not something they taught us about in real estate school, So it was a new form to me and that, so it sticks out to
Yep.
me always. But so you'll fill that out in box 3 there, right, Beck?
Yes, for the additional right to terminate for X amount of days after it's been executed, and you're essentially agreeing to it, buyer and seller agreeing to the terms of the property for conventional and has to appraise at X price that you put in that box. Otherwise, they have just like the FHA VA provision, they have the additional right to terminate. And then we can get in the weeds on another day, another class for waiver and partial waiver. But for the context of just meeting the entire appraised value for conventional FHA, VA, for both of them, it's going to be the sales price that you're wanting your buyer or borrower for the property to meet, and that's going to be on page 1 of your contract.
And can you also say, just like we were talking about the most common or reasonable amount of days for the buyer financing, for that additional right to terminate when you have the ability to write in numbers of days, if you have a 30-day contract, how many days would you typically put in there?
For a buyer's agent, if I'm going to do
Yeah.
if I've got a 30-day close, I'm going to at least put 27 days. I know that any good lender is going to have a appraisal in long before that, but
Mhm.
at the same time, the clock starts after your executed date. So
Mhm.
sometimes we all know that every once in a while there's an appraisal that comes in late, or we are very prone to storms and power outages, and an
Yeah.
appraiser could have went out there, but their due date, like they could have went out there within your time prescribed, but by the time it's in and reviewed and sent out to everyone, it could be, you could be pushing up to that
Um,
wire before you're actually been told what the appraised value is. So if I'm doing a 30-day contract, 20-ish, heavy on the latter
ish.
side of 25. Yeah. And then obviously proportional to however long my contract is. If it's 45 days, it's going to go out. If it's 60, 90, whatever, that date, it's going to be proportional with the amount of days. Because if I have a 90-day contract, I couldn't imagine that a lender is going to send out an appraiser on day 21. Like
Yeah,
it's just,
Right.
it's a while. So you want to make sure that your dates are aligned with the amount of days that you have for closing.
I love it. Thank you.
And the last thing I'll say
Hmm.
on the appraisal, because I said there was 4 options, there's actually a
Oh,
fifth
yes.
option.
Let's do
The
it.
fifth option is you're going to get an email from my team if it under appraises, and it's going to go out to the buyer's agent and the listing agent, and we're going to say, also, here's the reconsideration of value form. So if the buyer's agent and or listing agent thinks that there's other comps that should have been used that the appraiser should have looked at, or one that maybe just closed that's not in the system yet, they can put those MLS numbers and have the appraiser review that. Now, the buyer does have to agree to that reconsideration of value as well, but there is an opportunity for both sides to submit comps. So to try to get that value up a little bit higher. So I should mention that as well.
I love
And
that.
I
Thank you.
do want to put out there just for a buzzword, just because I know the very first time I ever heard it being as a baby agent was Tidewater with VA.
I was going to
I
say that.
thought that somebody was playing a joke on me. I'm like, I'm sorry, did you say Tidewater? What, Tide Water? Again, like what?
You're
We're
like, you're
not,
not making sense.
yeah,
Yeah.
it's still not making
Yeah.
sense. I don't know why it's called Tidewater, but for those listening and those watching, if you have a VA loan that comes in and the appraisal is about to come in low before it even comes out, that appraiser is going to reach out to either the lender, buyer's agent, listing agent, says, "Hey, we got a Tidewater," and that means that is your signal before it's released. Like, hey, it's going to come in low, and I've seen it as low as like $1,500. Like sometimes it's not
Mhm.
a substantial amount of money. It can be a small amount all the way up to, I've seen large gaps. But either way,
Yep.
you're going to hear Tidewater. It is a very real term, and that is only specific to VA loans if it's going to come
That's
in low.
correct.
Well, and I love
Yep.
that y'all both brought those up because we talk about in our pricing class that price is all about justification. And I say that about how if you're not, if if somebody challenges you, whether it's another agent or an appraiser on how did you get to this price and you can't justify it to them, you immediately lose leverage. So I love that y'all brought that up because those are specific examples of when you're going to have to be able to make sure you could justify the price that you guys were listed at. So thank
That's
you.
right.
3-day
Yep.
closing rule and closing disclosures. Can you share a little bit about that and what that means? I think a lot of people that are new to this are not going to really know what that is.
Yeah, so the initial closing disclosure, it has to be released at a minimum of 3 days prior to closing. And you also have to take into consideration holidays and things of that nature because they don't count in that 3 day rescission, period, or that 3 day period, right? So you have to have that 3 day period. And if you don't send out the closing disclosure within 3 days of closing, then you're going to push closing. And there's really no exceptions to the rule. So, I mean, it's important as a lender to make sure that we're staying on top of our game to make sure that we've got what we need to, at the very minimum, get the initial closing disclosure out 3 days before closing. It's going to have the estimated final loan terms, estimated final monthly payment, estimated closing cost, and your estimated total cash to close. All going to be estimated because even if we send out the initial closing disclosure and say you find a better insurance, premium or whatever that looks like, those things can still change even after that initial CD goes out. But as a lender, I have it on every single file. I know exactly when my last day to send out this closing disclosure is to ensure that we hit the close date. We can send it out as early as 10 days prior to closing, but that's the earliest that we'll ever send it out. Now, other lenders may be a little bit different, but we're trying to get that initial closing disclosure out as quickly as possible, uh, just so that we're meeting that 3 day
Okay.
period.
I love it. Thank you very much, sir.
So yeah.
And then closing costs versus cash to close. We talked about that a little bit at the very beginning. If either
Mhm.
one of you want to just reiterate that too, or if there's anything you want to add to it.
I think it's good to kind of just revisit it just real quick, but essentially what we're always paying attention to, and this is a great way you have it here, is just you have your down payment plus your closing costs, plus your escrow account and or prepaids, and then you're just subtracting out the earnest money, option money, and then any seller concessions that are negotiation. One of the things just to keep in mind is that the closing cost, I'm sorry, the concessions, that can change throughout. So the cash to close number can change, and anything that changes on the insurance, whether it's the hazard insurance or the windstorm, things of that nature, can change that cash to close number. And it's a constantly moving number till you get to closing and we get that final closing disclosure that's balanced between the title company and my closer. You're going to see some changes in that number because initially we're probably using estimated insurance, estimated taxes. We don't have the tax cert back from the title company, things like that, and any repairs or concessions that get changed. So that cash to close number will move around a little bit. So as a buyer's agent, if your client says, "Oh, my numbers keep changing," do the lender a favor and just say, "Hey, we understand that numbers are going to change. That's part of this process."
Yeah,
It's not necessarily a red flag or anything of that nature. It just means that we're getting updated information, so that's changing that number a little bit.
absolutely.
I
Anything
love
you want to
actually
add?
seeing like on a CD, where you'll see uh the estimated number, and then you'll see like I think it's called final or last or whatever, and they are typically wildly different in the best way, where your estimate is super, super high, and then where it says either actual or final, and then it's like thousands. And let me
Yeah.
asterisk that by saying that's not always the case, but the majority of the time it is significantly less because just like we're I'm gonna set expectations. I'd rather uh over promise and under
Yeah,
deliver, or vice versa. Like
under
I don't
promise
want
and
to tell
over
you that you
deliver.
only have to bring $5 and then now you have to bring 10,000,
Hmm.
and so I've seen that and I'm like, wow, like, I'd rather
Yeah, it's kind of
for
like
you
us
guys.
with our net sheet saying the worst case scenario and the best
Yeah.
case would rather, yeah, prepare you for the worst.
Mhm.
No, I
Yeah,
love
and
that.
that's how we estimate. Now, not all lenders do that, especially out of town lenders. They don't know that windstorm's required. They don't know what taxes are. They don't know what appraisals cost. They don't know what our surveys cost. So I've seen out of town lenders come in way low, and clients are like, "Oh, but your closing costs are way higher." It's like, first of all, almost all closing costs are third party, fees. They're not the lender fees.
Mhm.
My lender fees are just these one or two or three things. So it can make a big difference if they're not familiar with the area And one last thing I'll say on this, and I know we got to move on,
Hmm.
but if you're in Jefferson County and you're going to use TWIA, a lot of lenders now, including ourselves, are requiring that at least 1 month or a full year's premium of windstorm be paid up front because TWIA, Texas Windstorm, will not actually finalize or implement the policy until they receive at least the first month payment, if not the full payment. So, in order to avoid closing on a Friday and Texas Windstorm not having coverage on a weekend, we will require at least 1 month to be paid up front.
Wow,
I love
that's good
that.
to know.
So,
Yeah, and also just don't forget to remind your clients that that cash to close has to be paid at title via cashier check or a wire. And currently, not saying this will always be the case, but certain title companies are wanting to hold the cashier check for 24 hours. Is that right, Beck?
Yep, to verify
Yeah,
funds.
for
So
fraud. And also with wire fraud, we have you guys sign a wire fraud warning as part of our compliance system and your files, but don't get in between the lender and the client for their wire. Have them reach out to them directly. That's something you definitely don't want to put yourself in that chain of liability. And also, it's not going to be emailed to them. They're not going to be emailing them the instructions. That's how people end up getting uh, wire fraud done on them.
victims, yes.
Victims, yes. Okay, you want to talk about this back real quick?
Yes, paragraph 9 and paragraph 10 of the residential, or the Trek 1 to 4 family residential contract. Paragraph 9 is going to talk about your closing date, and that's the date that you guys, the buyer and the seller, have agreed to close. And then paragraph 10 talks about possession of the property. And that also goes to, like, you can close and you can check box closing upon closing or funding or according to your temporary lease, but for the context of this class, we're going to talk about closing and funding like the day that you're closing. There is no lease involved. And possession of whenever a buyer can possess the house is going to be when the lender has given funding authorization to the title company. And I want to emphasize strongly that there is a big difference between funding and disbursement of funds. A lender can have sent the money over to the title company and they can the title company can have the funding authorization from the lender. But if it is 4:30, 3 o'clock, or I think it's 3:30 when wires cut off, or if it's on a Friday, or if the next day is a holiday, you can have funded and not have disbursement of funds. So that's very different, especially with sellers. I get sellers want to have their money, but you can have funding and not have the money in your bank account. So it's really important. Or vice versa, if a lender hasn't sent the funds already ahead of time of closing or does table funding or whatever, and you're going to have a late closing, sometimes it's not going to fund to the next day where the lender has actually sent the funds. Or if it's on a Friday, and it's Friday at 4 o'clock, it's not funding until Monday.
Absolutely. Zach, do you have
yeah.
anything you want to add on that?
I mean, a lot of times we'll issue funding authorization, but that's not the same as disbursement. A
Hmm.
lot of times, depending on the agents involved, once we send out funding authorization to the title company, and a lot of times I'll just send a text message to both agents and we send our own emails just saying that, hey, we've issued funding authorization to the title company. A lot of times that's when, maybe keys will exchange hands, things of that nature. But a lot of times it's not going to actually have funds being dispersed until the very following day or the next day
Absolutely.
or
Yeah, and
whatnot.
And
this
I
goes a
also
long way
think,
with managing expectations because if
yeah,
you have a
like,
buyer with a U-Haul full of things, you want to make
Right.
sure
well,
that they're aware if they're not going to get the keys that day.
and I think if it's a buyer's agent and a listing agent, but whenever you receive that contract on the listing side or you're writing it up as a buyer's agent, you have to, like, you just can't just arbitrarily pick 30 days out. Like if that's going to be on any holiday or a Friday or whatever, your buyer's out of town, like it's like you've got to be mindful of the date that you pick because like I said, big or small, it's an agreed upon term. No matter how big or small, you have to have an amendment to change it. And
Absolutely.
so I'll see it a lot. I'm like, hey, that's on a Monday. That's like Juneteenth, or how we celebrated 4th of July on a Friday. I'm like, you're not closing on that day. Everyone's closed. They're like, oh, I didn't even think about
Oh, and
it.
that's a good thing too, because in the new contracts, they've updated the legal holidays and what those mean. So yeah, make sure that you're aware of those for sure and not including that as the date that you're closing on. Thank you for bringing that up. Okay, you want to talk about some of the don'ts and stuff that you've seen buyers, encounter or that can blow up a deal, Zach? That's always the least fun thing
Uh,
to talk about or to
I
encounter.
mean, it really, from a buyer's agent standpoint, if you can have this conversation, you don't have to know anything about lending whatsoever. But if you can have this conversation with your clients during, before, after they get pre-approved, it doesn't really matter. If you just mention it like once, that would go a long ways, because you'd be surprised at how many times somebody gets married during this process, which is fine. We can deal with it, we can work with it, but depending on the loan program, that can change things,
Mm-hmm.
right? So, I mean, in an FHA loan, we have to take into consideration the non-purchasing spouse's debt. So if they're not married and then you get married and you marry somebody that has a lot of debt, well, guess what? Now we get to qualify you based
Now you
on
get the
their debt
divorce.
and your income. And if they're not going to be on the loan and they don't make income, then all of a sudden maybe we don't have a deal anymore. So we love the fact that people get married. That's exciting and fun, but please like have that conversation, with us, the lender, beforehand, and or if you're a buyer's agent, ask your clients if they look like they're getting married, if they just got engaged. It never hurts to go, hey, when's the wedding? Just so we know it's not going to happen in the middle of the transaction.
Absolutely.
Um, don't buy a car in the middle of the process. If you do, let's talk about it. Let's
Mm-hmm.
ideally you wouldn't, but hey, we can do it. We just need a communication, back to communication,
Yep.
quitting your job, changing jobs. I've closed many a deal where people are changing jobs in the middle of the transaction. It's okay. But if I don't know about it, it's not okay. I've
Mm-hmm.
also gotten to the closing table when somebody quit their job the day before. So it can happen. You can be the best lender in the entire world, but if your buyer is not communicating with you, things happen, right?
Mm-hmm.
One of the biggest things recently is Klarna or Afterpay or any of those types of deals. More and more and more people are using Afterpay and Klarna for like concert tickets or like small things, maybe a $200 purchase, but it's a $15 a month, monthly payment, right? Well, if you have 15 or 20 Klarnas, guess what? We now have to take that into consideration from a lending perspective. Whereas before, we only had to take into consideration what was on the credit report. But since Klarna is actually like technically an installment loan, now we have to take those into consideration. So I know Klarna is fun. I know Afterpay is fun, but like maybe don't use it so much if you're thinking about buying a house.
Absolutely. Yeah. It feels smaller, so it feels different, I think, a lot of times people maybe mentally, but yeah, they don't realize how much it could affect things. Thank
Yeah.
you. Okay, and then these are just a couple of mortgage myths that you had sent over that have been debunked, if you want to talk about those a little bit. Some of them
Yeah.
we talked about a little bit already, but
Well, credit scores, you can overcome bad credit. I have people all the time that we can't qualify them right now because they have a 539 credit score. Okay. We can do what's called a rapid rescore. If they have the ability to pay down some debt, they can pay a third party to basically go in and update the credit report based on new information, because a credit report's only a snapshot in time. It's
mhm.
not necessarily the end all be all. So people can pay off things all the time, and then maybe they didn't qualify a month ago, but maybe they paid something off, and we get that information to the credit bureaus, and now all of a sudden they qualify. So we can absolutely overcome bad credit. People have bad credit. People do things in their past that they're not proud of when it comes to credit, and we can overcome that. We've all been there, right? So
Yep.
it's all good. Mortgage cost. This kind of comes back to, oh, my cash to close number is changing. It's going to change, right? There's going to be things that change. There's going to be things that pop up. Maybe it didn't need a survey because it was existing and title thought it was going to be approved, but now maybe it's not approved because of X, Y, and Z. Like, it's not that the lender's trying to make you spend more money. We don't want to do that or necessarily care. We care about communicating the most effective information to you, and I'm always going to be conservatively on the high side every single time from the get go, because I'd rather come at you with lower cash to close than higher cash to close.
Mhm.
And so I try to be very conservative on the front end. So you will likely see your fees and costs go down unless you decide to get an insurance quote that's a lot higher. And that's your prerogative. So there's
Mhm.
things that happen that are out of my control. So it's not necessarily the lender nickel and diming you with higher or lower fees. It's just that we're only as good as the information that we have in that snapshot of time, and that information can change a lot of times throughout the lending process.
Absolutely.
So that's kind of that one. And then
We
this
talked
one we
about
talked
loan
about, you
credit.
don't have to have 20% down. We have down payment assistance programs. We have an in-house guild program with 0% down. So we do have some great loan programs like that that don't necessarily have way higher interest rates and things of that nature. Just get with a local lender and have that conversation.
Absolutely. And then I think this is our last one. So, 4 tips for a buyer's first home purchase. A lot of our new agents may be working with a lot of first-time home buyers. Some people, that's the niche that they even want to go after. So, if you want to share a little bit about some of that, I know you talked about some that y'all have some specific programs that could maybe help them even. So, um,
Yeah,
just a little
and
overview.
just in the essence of giving the best information, but also trying to keep this a little bit not too on the long side.
Absolutely. Yeah.
Realistically speaking, get with a local lender, be upfront and honest with them, tell them everything. The lender's not the underwriter. They're not the one underwriting. They're not the one giving you credit approval. They're your advisor
Mhm.
to get you into a new home. So don't be worried to give them all the information. The more information you give the lender up front, the more documentation you give them on the front end, the better the whole experience is going to be, and the better that that lender can help you get into a home, whether it's now, 6 months from now, right now, or a year or 2 years from now. The goal for every lender should be give me the information, let me critically think about it, and get you the best options for you to meet your family's needs. So, the more information, defining your goals, giving them all the info is important and it matters.
Absolutely. Yeah, we had a class today, Real Estate Perspectives, and it was talking about leverage and some of the different things that are important in your business when you're building a business. And one of them was relationships, and not just with our clients, but with our ancillary arms. And it's a great way to wrap this up, I think. But we talked about the importance of having a great local lender. And I don't think that agents can, I don't think we can stress it enough of building those relationships with those in our community because you really are a team in it. And I mean, the closer that you are, the better you communicate, the better relationship you have, the smoother your transactions most of the time are going to be. Of course, there's always roadblocks, but it's a big deal to have. So thank you so much for joining us today and
Yeah.
for sharing all of that good information. And anybody that sees this and wants more information on how to contact Zach or the people at Guild Mortgage, reach out to us. Becca, we have his number. We're happy to share it with you. You can shout it out here right now if you'd like. Uh,
Give me a call on my cell phone anytime, 409-273-9744. Text me, call me. I'm here to help, whether I'm part of the loan or part of the lending process that you're involved in. Maybe even right now, I'm always happy to answer questions and just be that sounding board or help in any way that I can.
Thank you so much, Beck.
Thank
Do you have
you.
anything you want to add?
No, I am good. I mean, just I thought building relationships is key. Whether you have a buyer client or not, like building the relationship now, even before you might have that buyer client already in your pipeline, that you have a resource you can send them to, is going to be paramount and moving forward in your business and growing your business.
Absolutely. And thank you for your input today, too, Beck. I appreciate you both so much. Y'all are amazing. And I'm going to go ahead and stop this.
Thank you.